Hey y'all. So I am going live. Today is not as busy as I thought it was going to be. So I was trying to debate, should I do a YouTube video? Hey, I am going live. I didn't know if I should do a YouTube video or if I should just go live. So I said, let me just go live, see what y'all want to talk about, see if we could talk about some mortgage things and this market. It's really crazy. So good morning. Hey everybody. Thanks for joining. I just have some stuff I want to get off my chest about this mortgage industry and all of these changes. That's so cool. People are joining. So I want to talk about the market. Good morning. How do y'all feel? I just feel like every year it's always something new that we're having to deal with in the mortgage industry. Always something. So when it was the pandemic, we were like, are people going to be able to buy houses? You know, are they going to lose their jobs? What's going to happen? All these foreclosures and forbearance and all of that fun stuff. And now, well, after that initial scare, 2020, early 2020, everything was really good. Everybody was buying houses. Rates were historically low. And I just feel like now we're about to get into a whole nother thing, but I'm kind of excited still because I feel like you'll be able to get people who are serious about purchasing a house now, and it weeds out all the people who are just trying to buy homes because it's the popular thing to do. So now you have to actually know stuff in order to be successful and in order to buy a house. You can't just say, oh yeah, rates are low, I qualify. You have to be more strategic. So I'm just on here talking because I was like, should I make a YouTube video? But I went live. So if you have any mortgage questions, let me know about this market. A lot of people are wondering, should I buy? What should I do? Rent is going up. So I feel like if you're looking for that next step and rent prices are high, you might as well see if you can buy because you'll probably work in a lot less if you are paying a mortgage versus if you're paying somebody else's mortgage or rent. But these rates, I am not afraid of these rates. They're just getting back to normal and people are still going to continue to buy. Once you see the investors stop buying, that's when you'll know it's a bad time to buy. But investors are still trying to rack up these homes, purchasing homes in all of the metropolitan areas. So if you can buy a single family home, do it. Do it. But I have some stresses all the time. Like, there's one thing as a mortgage loan originator that we do not get enough credit for what we do, but it's okay. You know, we do a lot of work to try to get your loans approved and get you to the closing table. And a lot of people don't value that. So I think that now that you have to be more strategic when it comes to your DTI and having to save more because, of course, these home prices are going up, loan officers y'all are gonna put some respect on our name. What are your thoughts about condos? I think condos are good. So it depends on where you are. If you're in a city or if you're there are condos in suburbs as well. But anytime you have like a shared wall, you just want to take into account those things. So that's townhome, condo, anything like that. It's going to be for your lifestyle. So condo is tomato. If you're getting an FHA loan, the condo has to be FHA approved. So you just want to make sure that depending on when you go through the mortgage process, find out if that condo is already FHA approved or if it can be FHA approved, because sometimes there are some interesting situations when it comes to condos. I had a situation, I want to say probably like a month ago, maybe 2 months ago, but the property was listed as a condo, and we went through the mortgage process as it being a condo, but then during the process, I want to say either the HOA or someone third party said that it was a PUD. A PUD is a planned urban development unit. So PUD and condo, those are two different things. So when the appraiser went out, the appraiser was like, hey, was he saying that it was a PUD? Somebody was saying that it was a PUD. Somebody that was saying that it was a condo. We as a lender, we don't see the property until the house goes through the appraisal process. So we're just like, okay, let us know what the property is. But they couldn't come to an agreement as to whether it was a PUD or a condo. And you can't just say, oh, well, figure it out. It's delaying closing. Lender, you pick what it is. We can't do that. So the appraiser, I think the appraiser was actually saying that it was a PUD. But for whatever it was supposed to be, the master policy, I guess if it's a condo, there has to be a master policy for insurance. And the HOA didn't have that policy. So condos are fine. It's just you want to make sure that because it's a shared unit, shared space, that all of the paperwork aligns, they have the appropriate insurances, and whatever happens to the house next door can happen to your house, which that can happen with a single family home, especially since they're building all these homes close up. But yeah, that's what I think about condos. I would get a condo in the city. Who knows? What's a PUD? So a PUD is a planned urban development unit. I mean, I guess it's just like sometimes it can be multi-space. Hey, I have my real estate license, but I'm a mortgage girl. So PUD and condo, those are two different property types. So, it could be a single family home, multi-unit, it could be a PUD. And really on the mortgage side, we just want to know what type of property it is, because there might be just additional guidelines or requirements depending on the property. Same thing if it's a manufactured home. A lot of people will come to me and say, oh, I think I might want a manufactured home. And manufactured home, that has their own type of different guidelines and requirements. So you just need to know your property type, because when it comes to the lender, like, we're just going to go based off of what the appraisal says. So that would be more so a real estate question. And do people live in PUDs? Yeah, it's a property type. So people do live in PUDs. You just want to make sure that when you're looking into what type of property that you want, that just ask your loan officer if there's any additional guidelines based on the property type, or that way we can let you know. But hey, y'all, don't manufactured homes have titles like a vehicle? No. So the thing is with manufactured homes, because I've done manufactured homes, but it's funny because until you do them, it was hard for me to even understand what a manufactured home was. So the biggest thing with a manufactured home is that it has to meet HUD's guidelines for a permanent foundation. So if it's not a manufactured home or doesn't meet guidelines, I guess they can pick up the house and move. But if you're going through a mortgage, they want to make sure that, hey, this house has a permanent foundation, can't be moved. So you have to have a structural engineer go out to the property, and you have to have an appraisal. So if you get an inspection as well, that's like 3 different type of people that you're getting to inspect to make sure that your property meets whatever you're looking for. So manufactured homes, they have to have a permanent foundation. It could be double wide. Think of it like a trailer. Some of them don't even look like trailers, but I know double wide manufactured homes are popular, but they don't have titles like a vehicle because they can't move. Because if they can move, then they most likely don't meet HUD's permanent foundation requirements to be a manufactured home. Look at me knowing stuff. Let me find out. That's a good question, though. I've even had somebody that was like, hey, I think this is a partially manufactured home. But again, in the lender's eyes, it has to be one or the other. It's either a manufactured home or it's not. So if it's half, then we're going to look at it as a manufactured home. So, and there are additional guidelines as well. So if you're trying to get a manufactured home, just make sure that you are letting your loan officer know. Because the thing is, somebody might make a decision to do manufactured home and just go under contract without talking to the loan officer. But there might be added guidelines. Like I think one was somebody was trying to do down payment assistance with the manufactured home, and they had a payment shock. That down payment assistance program had payment shock. And payment shock, that basically means, let's say if your score is under 640, then certain programs might say, well, we don't want you to have a payment shock of 125%. So that means if your mortgage payment is over that 125% threshold, then you won't qualify. Or he actually had to put down his own down payment because the payment shock, I think he only paid like $700 for mortgage. So 700 times 125 is $875. So his mortgage couldn't be over that. That's not really a lot of wiggle room, because if you're looking to expand, you might fall into a payment shock issue. But luckily I know a thing or two about manufactured homes with these questions. Any other mortgage questions that y'all have? I just wanted to get on randomly because I was like, I don't know, maybe I'll do a YouTube video, maybe I won't, but I don't know what I would talk about because so many crazy things are happening, and I have to watch how I vent because being in the mortgage industry is stressful, and I want to remain politically correct a little bit. So let's see. Well, another thing that I wanted to talk about too is having enough money saved for closing costs. I feel like a lot of people, before it was a thing, everyone was being really good. We were saying, hey guys, make sure that you have enough money saved for closing costs. But now I'm starting to notice that people aren't factoring that into the amount that they have saved. So closing costs is very important when it comes to purchasing a home, and we can only give estimates as your mortgage loan originator. So until you go under contract and we see the title company that you're going to be using, or we can actually take a look to see the property and what the property taxes are for that property, you're going to be getting estimates. And a lot of times I'll see that people will say, oh, well, this loan officer or this bank, they gave me a lower estimate on closing costs, but they might not be giving actual estimates. So when you get to the closing table or you get closer to closing, you'll see a jump and they'll say, oh, well, this is your actual numbers, basically it's BS. So you just want to make sure that you are not making your decision on whether you choose a bank, because I see somebody had a question about a bank, or going through a lender because of closing costs. They're estimates. Most of the closing costs that we get are going to come from the closing attorney, the title company. They're going to be able to give us actual fees during the process. But if you're working with a good lender, we can give you a good, accurate estimate. And a lot of times, if you're just working with somebody that it's transactional, like a bank, they're not going to give you a realistic estimate on your closing costs. So don't compare closing costs on your initial estimate or your initial LE. It really doesn't help because someone is just typing in numbers. What's the difference between going through a mortgage company or a bank? That's a good question. So mortgage companies, we do mortgages. These lenders are going to have different programs. To work with a mortgage company, you have to have your NMLS ID, you have to be licensed. And so the goal is whenever you're working with a loan officer, they're doing the pre-approval process. They're able to understand, look at the guidelines and say, hey, this person, can they meet and actually close this loan? That's a mortgage loan originator's job that's licensed. If you're going through a bank, 9 times out of 10, the person that you're talking to on the front end is more so sales. So the underwriter is going to actually be the one to say, hey, yay, nay, can we do this loan? There is no structure. You're going to be doing an application. And once they submit that application through, the underwriter will say, hey, yes, we could do this. No, we can do this. No, we can't do this. So when it comes to if you're not in a perfect situation, perfect credit, income, assets, reserves, like you don't have to make any changes to your application, you can go through a bank. But for the most part, whenever I am reviewing an application, the numbers that people put on the application are not accurate. So I'm going to know, okay, let me look at your pay stubs, W-2s, tax returns, all of those things to get your actual income. Because people round it up like, oh yeah, I make about $6,000, $7,000 a month. You might only be able to prove income of 4508. Like, you want to be as specific as possible on the front end, because your approval is going to be based on certain requirements like DTI and credit and all of those things. So working with a bank, the underwriter more so originates the loan. And then working with a loan officer, you have somebody licensed who can kind of make necessary changes, evaluate it. So that way, whenever you get a pre-approval from a loan officer and you submit it through, unless you change your situation, that pre-approval from approval, it should not change. Unless something comes up, maybe you open more debt and we have to add that to your DTI, or maybe your income didn't align. Who knows? But most of the time, if you go through a licensed mortgage loan originator that works with a lender, they'll be able to evaluate your loan on the front end, and the underwriter is just crossing their T's, dotting their I's, making sure that everything actually matches up for approval. Whereas we're going through a bank is more so like sales, like, hey, yeah, you want a mortgage? Sure, we can do it. Give me your information, complete this application. Then they submit that to the underwriter, and the underwriter, is the one readjusting, like, okay, well, we need to change this. Their income is actually this. We need to change that. And so you'll get a yay or nay. I even find that happens sometimes even with builders, lenders. It's more so transactional. They might not go through the whole extensive process and know that, hey, we have about 100 programs that you can choose from. They're just trying to see, okay, can we do it or not? What does the underwriter say? So that would be the major difference. Representation, trying to make sure that you qualify on the front end, going through a lender, someone who this is what they do mortgages all day, whereas you're going into your bank, it's more so sales. You're dealing with a banker, or even if it's they're not licensed, so they're going to take your application, send it through. I see your application. I know that most of those numbers are not going to be accurate, so I'm going to have to go through with your documents and make sure that everything is accurate on the front end, because I want to make sure that if I send out a pre-approval letter that you'll come back. We don't have to stress. As long as you don't change your situation, we're going into closing. So that would be the biggest difference. And then also making sure you use a loan officer that you trust and somebody who knows and understands the guidelines. That would be the biggest difference. But that was a good question. What's another good question? Mortgage questions. Ask me some mortgage questions. I was bored. Well, not necessarily bored because I'm always busy, but my emails, they weren't as crazy as I thought they were going to be. So I said, let me go live and talk about mortgages. And thanks for joining, y'all. So back to these rates then. Yeah, I just feel like it's going to get interesting because a lot of people are going to see that everyone is trying to promise rates on pre-approvals. And these lenders, banks, all of the above, if you're shopping for a lender on a pre-approval letter, it is just not the smartest thing to do because rates change daily. So now people are going to be trying to say, oh yeah, I can give you this rate, I can give you that rate, to try to get you to work with them on a pre-approval, but rates change daily. So when you go back to them and you're under contract, you're going to be like, oh, well, I thought that my rate was going to be 3.6 or 3.5. Those rates aren't available. But if we can't lock your rate on a pre-approval, it's taking too long for offers to get accepted, and usually typically lenders only lock your rates for a period of 45 days, 30 days, and 20 days, depending on where you are. But when we lock in your interest rate, if that 45-day, 30-day, or however long your rate was locked, if it expires, either we have to pay for an extension or you do. And 9 times out of 10, if there's no relationship, the borrower has to pay for extensions. Because if it's a situation, let's say your closing got delayed, something like that, if you're working with a good loan officer, they will try to extend your rate at no cost to the borrower. But if you're just trying to see who's going to give you the lowest interest rate on a pre-approval, it's just a waste of time. The best, if you are the type of person that wants to rate shop, just make sure that when you are doing it, that you're doing it when you're under contract. Do it during your due diligence period if that's what you want to do, but that's when you're going to be able to lock in those numbers. But it's the wild, wild west, so people are just going to tell you anything. What else? Do you have programs for individuals who want to purchase an investment property using their LLC? Yes, there are programs. Most of them are going to be conventional. And a lot of times people will transfer or do a quick claim deed after closing or at closing to put it in their LLC. But most traditional mortgage programs, they're going to want you to go through the process under your personal. What are the range for mortgage rates? So you can always Google mortgage rates. As far as the range, the ones that you see available is going to be for an A1 situation. So excellent credit, excellent credit and excellent DTI, not maxed out, all of those things. So whenever people are comparing mortgage rates, it's not one size fits all. So you have to go through the pre-approval process to see what your rate will be, because there are so many determining factors. So if you go online and you see that, hey, today's rates are 4%, whatever they say the rates are, that is for an excellent borrower situation, and it's not necessarily your situation. But what I typically do is I'll go over the rate that is at no cost. And then if you're really set on a lower interest rate, there are options to buy down your interest rate, where let's say a buy down, there's so many different options. You might want to pay 0.5% of the loan amount to get a lower rate, or, there are just different ranges. So you can buy it down, and that would be paying more closing costs. Slightly higher closing costs to get the rate that you want. Or the other option would be taking a higher rate, and then you can get a credit at closing. So depending on the situation, there are different rate options for each individual. It's not just one size fits all, but we'll go over, the rate that is at no cost for you. It's typically going to be the first one that you'll get. And then if after conversations, you might want to see, hey, what are my options to buy down my interest rate? Or, money is really tight. My closing costs are high. I really didn't budget for this. Is there any option that I can take a slightly higher interest rate and go towards closing costs? So you never know, and you have to have those conversations, because I've had people, maybe they wanted a $4,000 credit, and the difference, I have this in my hand because I was dusting, so don't judge, but the difference in their interest rate and them choosing the higher interest rate was only $30 a month difference. So that person was like, hey, I'll take the higher interest rate for $500, Alex. And there are so many different options. Talk about consistency in income, W-2, 1099. Oh, child. So income, that is going to be important. And that's another reason why you want to work with a licensed mortgage loan originator, because when you're going through the process, we can identify certain things by looking at your pay stubs, W-2s, 1099s, tax returns, all of those things, to try to advise you on what you need to do to get approved for a mortgage. So a lot of times people may think like, oh, I have to be on this certain job for 2 years. I can't, have any fluctuations. It just honestly depends on your employment status. So I actually saved another live that I did that went in depth about income. But if you're 1099, you're typically going to need 2-year work history. W-2 is a little bit more flexible. It just depends on your specific situation. So if you're part-time or you're using part-time income, if your income fluctuates, income varies, maybe you're a nurse or, we want to see a 2-year history to be able to average out that income. If you're salary or a 40-hour employee, that's a little bit, that was a great live. Thank you. I try to share my little jewels, but if you're full-time salary, that's a little bit more straightforward. So you don't necessarily have to have a consistent 2-year history. We need to be able to document what you've been doing for the past 2 years. So let's say if you were employed for 20 months and we only have 20-month history, that's not 2 years. So we're going to need to know what were you doing prior to that. So we just need to have a complete 2-year history of your employment. Or if you were in school, we need to document that you were in school. What were you doing for these 2 years? And it has to make sense to the underwriter. So another thing is the income expected to continue for 3 years? Well, W-2 income, hey, if I don't have any red flags on my job, that income is likely to continue if it's salaried, if it's full-time. If it's not projected to continue for 2 years, then you might need to have that solid 2-year history so that way it makes the underwriter feel comfortable in this income. So that would be a situation where, oh, can I use my full-time job? Can I use my full-time and part-time income? Okay, well, are you likely to do this for 3 years? We can judge it on your past. How long have you been doing this? Have you been working 2 jobs consistently for 2 years? Then most likely you can use that income. But if you can't show a pattern or if it's not necessarily a salaried W-2 position, then you want to make sure that you have those conversations. That way, once you have those conversations on the front end, if the underwriter reviews it and has questions like, oh, this person only has this amount of history, you can actually say, or the loan officer might not even have to go back to you. They can just say, oh, this was this person's situation. I'm going to have her write a letter of explanation to detail her 2-year work history. It just has to make sense. Like, would you give somebody $100,000 based on this current situation? Yay, nay. And the underwriter is not the one with the final say. They're going based on the guidelines. And if you know the guidelines, then you'll be able to try to catch as many red flags on the front end as possible. What other questions do y'all have about mortgages? Let's talk mortgages. Maybe I'll try to go live more to talk about mortgages. Any advice for someone looking to break into this industry? Run, girl. But no. The mortgage industry is a great industry to be in. I feel like people are becoming realtors and real estate agents every day, and they don't really look into the mortgage side. I love it. I feel like I have a niche. So this is something that everybody is not doing. People are becoming real estate agents every day, but I feel like it's a little bit harder to become a mortgage loan originator and to have consistency because there is a barrier for entry. It's not all about just passing your test and, signing up to work with a lender or a loan officer or mortgage lender. You have to be able to understand the flow, the workflow. You have to get in your flow. There's a lot of anxiety because you are a major piece in this puzzle of getting these people to the closing table. So if you are not comfortable with managing the stress of others and managing others' emotions while trying to overcome objections on your own and trying to figure out this big puzzle, which is getting someone to the closing table on the finance side, then I do say run. But if you're really good with, if you're really good and an analytical thinker, numbers, all of those things, sometimes I will sit there and look at my computer. Whenever you're doing a pre-approval process, you want to get an approved eligible when you run it through the underwriting system. It means everything on all of these different pages on the application, like there are so many screens, everything aligns. This person is good, approved eligible. But sometimes you might get a refer and you'll just be sitting there like, no, I know I did everything that I'm supposed to do. I just don't see it. And you have to sit there and figure out what it is. So it's not a situation where someone just gives you a computer, you sit down and you're like, okay, good, I'm a mortgage loan officer now. You really have to understand how to get each person's individual situation to the closing table on the finance side. And there's a lot of education. There's a lot of things because all loan officers aren't created equally. The underwriters are not going to tell you how to close this loan. They're not going to tell you how to meet these conditions. They're going to say, hey, here are 132 conditions, because you might just start out and you might not know how to catch all those red flags or know to ask for these extra documents because this person said that they have child support, alimony, and all of these things in 401k. So you're not going to know a lot until you start going through the process and saying, hey, this person told me that they have this situation, so I know they're going to need this. Collecting those things on the front end. It's a learn as you go type of industry. And so a lot of people will come in and then they'll leave. They'll be like, it's too stressful. I can't do this. But if you can stick with it, which is what I always try to tell people who start and who are new, if you stick with it, it'll be good, because we need more good loan officers. There aren't a lot out there, especially that look like us. Baby, you have to prove your worth, and that's just the truth. Just get in the door. Oh yeah, just to get in the door on top of managing people. Yes, it's a lot. It's a lot that comes into the mortgage side, but people are becoming real estate agents every day, and not the same on the mortgage side, but they both are very lucrative careers. If the bulk of your debt is student loans and it's causing your debt to income ratio to be high, will getting on a payment plan for student loans help bring your DTI down? Yes, it will. So with student loans, before FHA changed their guidelines, I still was helping people get houses with high student loan debt. I would just be like, you have to go conventional. But now people with student loans have the option to go conventional or to go FHA, because FHA opened the requirements kind of to mirror what conventional loans were doing for a really long time. So old days is if you had a FHA loan and you have $100,000 in student loan debt, then we would have to count 1%. Because typically people who have a lot of student loan debt, they don't have a mortgage payment on their credit report. Is either 1% or the mortgage payment on your credit report. Everybody and their mama is in forbearance or deferment. So most of the time it was at 1% and it was just hitting people and people can't qualify. Then they changed it to where it is now 0.5%, which is what conventional was doing, or your income-driven repayment plan. So if you have $100,000 in student loan debt, then instead of counting $1,000, that 1%, we count 0.5%, which is $500. So not only just that, let's say maybe my DTI is still high with that $500. If I'm under an income-driven repayment plan, maybe my monthly payment is $100. So if you can document proof that you're on an income-driven repayment plan, we can use either 0.5% or we can use that $100 income-driven repayment plan. So there are options. So if you have student loans, go through the pre-approval process, because now, even with them changing the rule and using 0.5% or income-driven, a lot of people with their income, they don't even have to enroll in an income-driven repayment plan. That 0.5% helps out. So it's kind of like maybe a car note, a small car note or something against your DTI versus counting $1,000. I say millennials and probably under, you have the millennial starter kit student loan plan, you're probably close to $100,000 in student loan debt. So that's almost adding a whole mortgage payment and trying to say, hey, I want to qualify for a home as well. So they've changed the requirements, and it's a lot easier to get a home if you have student loan debt. Alrighty. What else do y'all want to talk about? I love talking about mortgages. Ask me a mortgage question. First of all, what I want to know is today a holiday? I feel like I can't tell whenever it's a holiday. Are the banks closed today? I feel like I should operate like I'm closed. But my phone is still ringing. So the life of a loan officer, since someone asked, most of the time you're on your phone. I do so much from my phone. I can send out pre-approval letters from my phone. I still work a lot from my laptop because I need multiple screens when I'm looking at all of your documents. And, yeah. But you'll get messages, hey, I need to can you update this pre-approval letter for me? Or, hey, I just turned in my documents. So you'll get messages from agents trying to follow up with their clients. It's just a lot. You're constantly busy. So if you like being busy, it's a good career. You get to meet so many different people from different walks of life, and you get to be an expert in your field because the mortgage side is complicated if you're new to it. But once you start getting used to having those conversations and enjoying finance, you learn so much. And people will be like, oh my gosh, I learned so much from you. And you'll be like, really? You really feel valued. So I love what I do. At first, I used to be stressed. I'm not going to lie, but that's all a part of it. And now I still get stressed. So as long as you are fine with sitting in stress every now and then, come on over. Okay. Well, since I don't see any more questions before I log off? I'll save this live. All right. Well, happy Monday. I hope y'all enjoy your day. And thanks for joining. Let's see.